Why you should invest in US markets. As an Indian investor, there are plenty of reasons for you to invest in US equity markets. Equally, there are good reasons why one should avoid investing in US markets. In this episode of Market Secrets Investment Series, we will talk about why every investor should consider investing in the US markets. Investing in the US equities give diversification and exposure to global growth in the most stable currency in the world. You can consider investing in the US equities if you can find a cost effective way to do it. Here are some of the reasons that are in favor. Number one, diversification. Diversification is an important part of an investment journey. It helps one to reduce the volatility and risk of their portfolio, especially if the portfolio size is larger. As the portfolios get bigger and bigger over time, drawdowns can be larger in absolute terms. When your portfolio has 1 lakh rupees in valuation, 1% drop is a nominal loss of 1000 rupees. But if your portfolio is 1 crore, the same 1% drop in portfolio is 1 lakh nominal loss. As portfolios grow with time, many investors seek to reduce day-to-day volatility and large drawdowns. Investing in the overseas or foreign equity can provide some geographic diversification. The rationale for diversification is clear. Domestic equities tend to be more exposed to the narrower economic and market forces of the home market, while stocks outside an investor's home market tend to offer exposure to wider array of economic and market forces. In other words, unless there is a big global driver, most of the times Indian and US equities won't move up and down in the same direction nor necessarily with the same pace simultaneously. This will moderate the swings in your portfolio based on your asset allocations in the US or global equities. Number two, size. US markets are the largest equity markets in the world. As an investor looking to build long term wealth with equities over the decades, you should have some exposure to the largest equity market in the world. As of 2018, US equities accounted for 44% of the global equity market, far greater than the next largest market, China, which accounts for 9%. Indian market capitalization was only 3% of the global market size. Why size is important? Due to its vast size, most of the retail and institutional investors all over the world would always be chasing US equities and willing to take positions in this. Its size makes it so that it remains efficient and provide cues to the other markets globally. Being the biggest market, it also attracts the companies from around the world to be listed here as getting investing capital is easier in this market. Example, Make My Trip is listed in Nasdaq and Alibaba is listed in New York Stock Exchange. These are typical examples of companies listed in US markets even though most of its revenues comes outside the US markets. The liquidity and quality of top US stocks are simply unmatched anywhere else in the world. So the size of the markets makes a very big difference here. Number three, lower price correlation. Just buying different stocks or other assets alone won't automatically result in diversification benefits. The assets into which one is diversifying should have low price correlation with the assets already present in one's portfolio. Price correlation measures how closely the prices of two different assets are related. Price correlation can either be positive or negative. The closer to zero, the better. A high positive correlation, that is around 1, means that the asset prices move in tandem, offering diversification only in the name. While the high negative correlation, that is -1, would mean that the investment price movements will virtually cancel each other out, defeating the purpose of investing. For example, large cap Indian equity mutual funds will usually have high positive correlation with the Nifty 50 index because many of the stocks held by these funds would be from the Nifty 50 space. But anytime an Indian equity index is compared with the US equity index or vice versa, the price correlations are drastically lower. It's around the range of zero point 0.1 to 0.25. You can easily get this data from the open web. And number four, the famous names. Some of the biggest and most famous brands and companies are listed in the US. Top companies like Apple, Microsoft, Google, Amazon, Facebook, Tesla, and many other similar ones are listed in the US markets. Most of these companies are also MNCs, that is multinational corporations, and have internationally diversified businesses and revenue streams. We don't have equivalent companies for these in India. In that sense, taking exposure to US equities can be viewed as getting access to equities growth of some of these unique companies with global revenue and user base. These are great reasons to invest in US equity. It adds much needed geographical diversification to your portfolio and gives you exposure to equities that reflect global revenue and economic growth in stable currency that's recognized all over the world. If you can take cost effective positions in the US equities and have well tuned expectations, you should go for it. In the forthcoming episodes, we will talk about the disadvantages of investing in the US markets and the various ways you can invest in US markets from India. Do you think there are any other added advantages of investing in the US markets from India? Well, let us know in the comment section. Hit the like button if you find this video useful and share it with your friends as well. Also, subscribe to our YouTube channel and click the bell icon to get invited for the live sessions. Thanks for watching. Have a great day. Goodbye.